Hello and welcome back to the PPW podcast. As always, bringing you news, views, and interviews from the world of real estate, online marketplaces, and prop tech industries. My name's Harvey Hancock. I'll be your host today. I'm a news editor at Online Marketplaces. As always, we are with the geographically challenged Simon Baker, who doesn't know whether he's in Monaco, Madrid, or Melbourne. How are you doing, Simon?
I'm doing surprisingly well, having got off a plane not too long ago from Madrid, having then been in Melbourne. So yes, I'm a little bit discombobulated.
But you have your flights or your trains booked to Barcelona next week, I'm assuming?
Surprisingly, I am going to be in Barcelona at the beginning of October, and everyone else who's listening should be there for the PPW conference. We've got 300 plus people registered already. We'll probably hit 320, a bit more. C-level leaders from around the world, a great set of speakers all around the topic of AI and how that impacts prop tech and portal marketplaces. And at the end of the day, it's going to be a great 3 days in Barcelona, and I'm going to encourage everyone to come along and join in the fun, learn a lot, network with people who absolutely know what they're talking about. And it's as always, and we've done 39 of these now. It's absolutely worth coming to.
Absolutely. And let's not forget that there's some interactive sessions as well. We have the PropTech Startup Day on the Tuesday, and we also have 3 workshops also running on the first day of the conference.
Correct.
Run by Portal Ventures,
PropTechs
IOVox, and
and
PropTechs.
iVox.
That's the
Yep.
one. That's the 3.
Yep, they're the 3. And super interesting topics that they're all talking about. SEO and AI-driven engagement around listings, and of course, AI-driven voice and call technology. So definitely a must for everyone to come along and participate.
Have you got good events sorted out for the evenings?
Ha! Of course. That's half the fun of doing these things, is getting everyone together, having a drink or two, and really networking and getting to know each other much better. And
Absolutely.
a lot of deals have been done. I mean, actually, I'm just talking to some people from one of the companies coming. They happened to be in town, and I met with them for a few hours, and they said they loved the conference last year and they did a lot of business from it. And that's why they are sponsoring this year, because they loved it so much. So if you're interested in AI, prop tech, and what the future holds, come along. You'll learn a lot, and you'll meet a lot of great people.
And you get a couple of free drinks out of it as well.
If you only have 2, that's your choice.
It's the only reason I come. That's for a fact.
Oh, great.
Right,
I'll take note of that.
Right then, let's get into today's topic then. REA-Move. Last week we had a speculative.
Wait. They haven't done the deal yet. You just call it REA-Move.
That's all right.
Right?
That's the phrase that I'm coining, and that's the way I'm going to be referring to them until anything closes.
Okay.
So, I mean, the basic, ladies and gentlemen, is that obviously last week we did an emergency podcast after it emerged that there was a consideration by REA Group. They were going to be making a buyout offer for Rightmove. A bid has actually come in, and it has been unanimously rejected by Rightmove shareholders, with rumours that another bid is going to be incoming in the next week or so. Simon, you said that something was not going to happen, but now it seems like there's some smoke. Is there fire? Where do you want to take this one?
Don't know. Clearly, a few things, and I was chatting to an ex-REA guy a couple of days ago about all of this. Senior person, and we both came to the conclusion that REA probably got caught short in the whole process. They were probably a little bit underdone in formulating their views on what to do with Rightmove, and via press speculation, someone leaked out that this was being looked at. They were caught having to do a couple of things: A, make an announcement saying that they were considering it, and B, then having to get an offer on the table. So that's sort of where it got to, and sort of a couple of things happened once that occurred. First was the Rightmove share price jumped up, and everyone sort of guessed at a 30% premium, because that's sort of the standard. And the REA share price went down because of a couple of things, that someone's done the maths and they've gone, if I buy Rightmove, I'm either going to be dilutionary, I issue a lot of shares and thus dilute the business, or B, I'm going to have to pay cash and shares. Because it clearly can't be an all-cash deal, because how would you fund that? And if you're going to pay cash for the deal, it means you're probably not going to be paying a dividend for a while. And if you're not paying a dividend, then the shares are less attractive. So there was a downward pressure on the share price. And then what emerged was that REA had made an offer of cash plus shares, about £3 a share in cash and about 0.03 of an REA share or whatever it was. And the problem is, as the REA share price goes down, the value of that offer decreases. So what I think originally started off as a 27 or 28% premium on the closing price dropped to about 26% premium. So clearly the Rightmove board is going to say no. And it's as sure as night follows day. And they'd be saying, because if they say yes, they're saying this is the best offer out there. It's better than we can do growing the business. And there's no one else there going to offer any better price for the business. Now, clearly they've not had time to test the market to see if anyone else would pay a better price. So they're going to say no to that offer. And they're going to want to say, sharpen your pencil, come back with a better offer. We may consider it. They'll probably say no again, right? Because why would you say yes at this point in time? You're in no rush to sell. You've got a business that is doing well. It's delivering good value as a dividend stock for its shareholders. So I can say no. I'm not in a rush to sell. There's no urgency. And what's interesting around this, a couple of things is one is, the news coming out of England at the moment is that it's going to be a good autumn for real estate sales, which plays into the hands of Rightmove. Rightmove goes, well, it's a good autumn for real estate sales. That's going to be good for us. There'll be more listings, more agents operating in the market, and so on. That's good for our business. So what they'll be saying is, no, we're coming out of this sort of a bit of a slump, and we're going to be operating well into the future. So no, if you want to buy us, you're going to have to make a much higher bid. That's the first thing I think that's going to play into the hands of Rightmove and make it more challenging for REA, because they're going to have to sharpen their pencil. Second thing is we have to think about, and many of the listeners probably may not be aware of a process of how do you buy a listed company. And there are really two approaches. One is a friendly approach and one is a hostile approach. And more often than not, it starts with the friendly. You go to the board, you say, I'd like to buy your business. Here are the terms I'm going to buy them on, price per share or a share swap or whatever. Would you support this? Okay, so that's a friendly takeover. And if their board says, yes, I'll support this, okay, then they recommend to the shareholders to vote in favour of it. Now, they'll probably have to produce a lot of documents to say we as a board have looked at all the options. We've considered other ways in which we consider this offer is better than if we continue to operate the business standalone. We consider that this offer is better than anyone else is likely to put on the table, and so on. Which is why they've clearly rejected it. We could write the rejection before even REA probably put the offer in. Then there's a hostile takeover where REA or anyone goes, you know what? I don't need the board. I'm going to go straight to the shareholders and make an on-market offer. I will acquire all the shares on these terms, and it can be an all or nothing offer. It can be a partial acquisition offer, as long as the terms are clear of what's doing. And then the shareholders literally vote for it, right? They accept the offer, so they thus fill out a form and give their shares over and get cash and shares in return, or they say no. And if you reach maybe 90%, then the other 10% have to sell. Compulsory acquisition. And then REA would end up with the complete business. So at the moment, we're in the friendly phase of this whole negotiation. So that's the sort of my initial thoughts on it. And then the question is, well, what's likely to be the real premium? Now, I've been chatting to some friends in the hedging industry because this is where all the fun and games occurs, right? So you would have seen there's been a lot of shares bought and sold in Rightmove because it went from, I can't remember the exact price now, £5 something or other up to £6 something or other, because of this announcement. That was a big leap. Now, everyone who was a shareholder at £5 something or other is going, oh, I might sell now because it's risk-free. It's a premium on what the shares were worth. And then hedge funds guys come in and go, you know what? We believe that REA is going to increase its bid. Okay? So we'll buy the shares at 6 whatever, and then we will wait for the increased bid, which will push the shares up again, and then we will sell out. We'll make our 10% return, our 15% return, but they're buying shares in massive volume. Others, of course, will be betting, going, you know what, based on all the dynamics, we think there will be no bid, or there'll be no further bids, and the Rightmove share price will go back to in the £5 range. Okay, and they therefore basically sell it short. So they're basically placing the bet that the price will go down. So this is all the games that are now being played. Okay, it's like going to the casino with Rightmove shares. Okay, and these guys is betting on what's going to happen. The word I'm getting out there from both reports I'm reading and from people I'm talking to is that somewhere around a 40% premium, if not more, has to be placed on the business. And REA is currently sitting about 26%.
I read
So,
I read as high as 60 on a couple of articles. I mean, I'm not sure that seems a bit too high for me.
By the way, just because the board of Rightmove says yes, we accept this bid, it doesn't mean the deal's done. Got to be clear on that, right? Because the board aren't the shareholders; they are representatives of the shareholders. They are influential on the outcome, but it doesn't mean it's a done deal. So let's assume it's a 40% premium on the share. So that's sort of taking it up from, I don't know, it's probably taking up to £7.50, £7.80. I can't remember, it was about £7 at the moment, right? So it's taking it up a bit more. Question is, can REA actually go higher? And let's think about it. REA is 63% owned by News Corp, the Murdochs, at the end of the day. Okay. And the current deal basically gets them down to 50%. Now, if you increase your premium that you're offering, you either pay more cash per share, or you're going to pay more REA shares per share. If they pay more REA shares per share, then Rightmove becomes, at the moment it's projected that they would be an 18% shareholder of the combined business, the current Rightmove shareholders. That probably increases to around a quarter. So a quarter of all the shares will now be held by Rightmove existing shareholders, which means News Corp goes below 50% in its ownership, which could be a problem for them. They may not want to do that for various reasons. And that can be both accounting, reporting reasons, as well as control reasons. And then you've got this other very interesting dynamic, which is not spoken about much, but is absolutely real. The reason that an REA trades at a ridiculous multiple. I don't think people have really understand just how it's price earnings ratio. So its share price compared to its earnings is 87 times. Right, 87 times a price earnings ratio. And to give you a comparison, Apple trades at 33 times price earnings ratio. Just as a comparison of one of the biggest stocks in the world. Okay, so that's a lot of inbuilt future belief. You know, if it's 87 times, it's basically saying it takes me 87 years to get the value back from what I invest. So you've got to believe in a lot of future value being created. And one of the reasons it trades at such a very high PE ratio is because News Corp owns 63%, which means that the non-News Corp ownership is 37%. Now, in Australia, because it's in the top 50 shares on the market, all the superannuation funds have to own REA shares. So you now have a lot of competition to buy shares in REA, but only 37% is really available. In fact, it's less than 37% in reality. So you then end up with a very high share price as the demand is outstripping supply in shares in this case. So therefore, if REA is dilute, so if News Corp is diluted below 50% and the Rightmove shareholders come in and are 25% of the overall shareholding, and many of those shareholders do not want to own shares in an Australian listed company. Yes, it's going to be dual listed, they say, but they probably don't want to own shares in it. Your free float goes up. If your free float goes up, there's now more supply of shares, but the demand is probably the same. So therefore, in theory, this could have a downward pressure on the REA share price because it's just more shares floating around. And the price earnings ratio would then come down to something a bit more realistic than 87 times. So that's something that's not often talked about, but is a financial engineering issue that I think is real for them.
To what extent is this going to scupper a move, have all these dynamics? Is this something that the Murdochs, etc., are happy to sort of just push through and we want this asset and it doesn't really matter, we'll get our value back over time? Or is it a significant enough hurdle that REA or any other potential bidder is sort of going to have to be, scared off by the potential ramifications of actually seeing a bid of this size finalize?
Um, so, so I think it makes it hard for REA to go too much higher in its offer without it then becoming too dilutionary on the overall business. It has the potential to impact their share price. They need to raise more cash, probably take on some debt. I think what it does is bring into play private equity firms. Okay, remember, REA might be worth in US dollar terms. I think it's about $18 billion. CoStar's $30 billion. It's double the size again. Okay, so let's not get confused. The CoStar's still the big game in town, and they might be looking at it. If I was Andy Florence, I'd be looking at it, going, how can I make this work? Okay, and I don't know. Maybe CoStar shares are more attractive than REA shares, and it's less dilutionary, and there's less impact on. So maybe they come with a bit of cash and shares into it. Okay, and so on. So there's a whole bunch of things that just may play into this process that opens up the door for another potential acquirer to put a bid on the table. Maybe a private equity comes in because they can raise debt against this because Rightmove is a very strong cash generating business. So I think the game has got a long way to go. Right now, a long way to go.
Do you foresee a bidding war?
Yes, I think it's shown that Rightmove is available, and I think the question that I would be asking myself if I was a private equity firm is this already fully priced? Can I get more value out of the asset? And has it been a lazy asset? I don't think so. Right? Can I somehow extract more value? I don't know. I don't think so. So do I bidding war? Maybe not. Maybe not actually. The more I think about it, if the only people who I would think would be good buyers for it would be CoStar and maybe REA. CoStar, I think, because they've got an absolute desire to get into the UK market, and REA because they're clearly looking to grow their business outside of Australia, because you can't keep just putting your prices up in that market and capturing more value. The question is, who brings additional value to the outcome? And it's hard. I mean, if you read the REA press announcement, they say, we're going to bring in technology and a range of other sort of things to increase the value of Rightmove. I think that's all rubbish. At the end of the day, I don't think you can, from Australia, increase the value of an asset in the United Kingdom. I know I tried with Property Finder way back when. The one that's been talked about a lot is VPA, vendor paid advertising. And
Not convinced.
people go, oh, yeah, you can get the home sellers in the United Kingdom to pay for their own advertising. We'll do the model in England as we do in Australia. Problem is, there's a culture of paying for your advertising in Australia, and there's no culture for paying for your advertising in the United Kingdom. So you're really asking to do a massive cultural change, which I would be very... I certainly wouldn't build an acquisition business case around doing that. And I think everyone forgets, and they probably do forget. Maybe it's because I've been around longer than most, and I've probably forgotten more than I remember. Is that Rightmove about 14 years ago, maybe, tried vendor paid advertising. And the way they did it was they allowed a homeowner, via a button on their listing, to upgrade their own listing. Click here, buy a feature property, go to the top of the search, stand out or whatever. And you can either go pay us directly, and it's £500 or whatever the number was, or go via your agent and pay £350. So they included the agent in that process. Failed. And they killed it after 6 months of trial. More or less. But, those corporate memory things tend to have a habit of disappearing. And people go in, you know what, I can do this. I can do the same thing again. And the answer is, you probably can't.
Am I wrong in sort of bringing in Purple Bricks as an example here, where it was essentially vendor paid advertising, but there wasn't an agent actually selling the home? The whole problem with Purple Bricks was that the user was paying to list their property, essentially, but the property wasn't being sold. Is that sort of a VPA play in any way, shape, or form, or am I sort of muddying the waters here?
Muddying the water, I think.
Okay, apologies.
I think that was more of use Purple Bricks to sell your home. So you didn't have an agent as well. You had Purple Bricks, and they did a lot of the work an agent does. You did some work as well. And you sold your home and you saved some of the commission. But we have to remember the commission in the United Kingdom is 1 to 1.25%. The average in Australia is around 2%. So you're playing, and out of the 1 to 1.25%, you have to pay, the agent has to pay for the advertising. So you can't squeeze that lemon too much more, and still capture more value. It's just not there.
I mean, talking about squeezing the lemon, I'm looking at Rightmove's share price here historically. 2022 was the historical high, it looks like, 632 per share. Now we're at... Sorry, 767. 767, and now we're at 694. Does the fact that REA and potentially another bidder coming in mean that it's sort of the game's up for Rightmove in any form, in that it's never going to be as good as it was, and as you say, because there's such little value to extract from the business anymore, it's sort of the beginning of the end, as it being this powerhouse share or anything like that?
No. I mean, you have to look at this through the lens of what else was the market doing.
Okay.
So think of it this way. Rightmove is a dividend yielding stock. Okay. By the way, its PE ratio is 27, not 87. Okay. But it does a dividend. Okay. So when interest rates are basically zero and you've got to earn money as funds managers, you take your money, you buy Rightmove shares because it's a stable share that gives you a dividend. Okay, and I don't know what the dividend yield is on this, but I'm sure we could work that out pretty quickly. Okay, so and that would pay a nice healthy dividend every year. Okay, and actually the dividend yield is 1 to 2%. There we go. Right, and then what would happen is when inflation sort of start to come through, and that sort of aligns, right? Because if you go back, that peak share price was in sort of the end of 2021, so you had 22, 23. Okay, inflation's coming through. The world's, all the all valuations came off across the world, and people are going, wait a second, I can get bonds. I can buy bonds, yielding bonds, dividend yielding bonds, with good coupon rates, that pay higher than Rightmove. So I'm better off just putting in a bond without any risk. And remember, you also got to take into account the crappy political environment in the UK. There's been a lot of talk around the housing market and affordability and a whole range of issues, and there was all that political issue before they changed government recently. So, no, I think a lot of it's factors outside the control of management, not within the control of management, that affected that share price. Now, of course, interest rates are going in the other direction. We saw a 0.5% decrease in the Fed yesterday, which is now going to mean more money starts to come out of these sort of long bonds, 5-10 year bonds, etc., and going back into more riskier but better returning assets, which is going to be good for the industry. Which means over time, I expect to see the Rightmove share price go back anyway, would start to grow anyway, as long as it keeps doing a dividend yield. That's how I sort of think about it. So no, I don't think it's got anything to do with the end of the road or anything like that. It's just it was a function of the overall circumstances.
Fair. I'm with you. I mean, thank you very much for the education, Simon. As you can tell, I'm a newbie to stocks and shares, and we have an upcoming episode with you about what it's like to be part of a public company, how to list, how to run it. It's going to be a fun one.
Yes, a lot of headaches. That's all I'm going to say as a preemptive move. Everyone thinks listing a company is the holy grail. It can be the holy headache, I'll tell you, of doing that, and it doesn't always deliver results. But I've done it 4 or 5 times now, so we're going to talk about that as a separate episode coming soon.
Perfect. Well, we'll keep an eye on the REA-Move rumors. Is it going to go ahead? Is it not? But until then, we're going to say goodbye from Simon Baker.
Yeah, and it's goodbye from him.
And it's going to be goodbye from me. Goodbye. Thanks for watching.
Okay, thank you.